We are back with Dav Rohinton, portfolio manager at IA Global Asset Management. Let's talk about a story that I think we've neglected. France, one of the major economies of the world, there are fears over political stability in that country and background worries over government debt and the push for spending cuts, which has not been well received.
No, not at all. And I think it's important to go back to actually the election that was last year to really set the table for what's going on now. So what happened in 2024 when Emmanuel Macron, the current president, did the snap elections, there was basically a consolidation of the left-wing vote. Actually, ironically, there's some through lines you can see in Canada where the left-wing vote consolidated, and there was strategic balloting that was going on. So
to support the Liberals.
Yeah. And in France, the same dynamic happened where the left-wing Socialist Party and the En Marche party, which is controlled by Emmanuel Macron, they didn't compete against each other in the runoffs.
Oh, okay.
So that's how they basically beat the National Rally, which is Marine Le Pen and Jordan Bardella's party. That's how we got to where we are today. But now comes the tough part, because the deficit keeps rising in France, and the appetite to basically manage the deficit on the cost side is very low. So that's why the left-wing parties are basically pushing back and forcing a no-confidence vote here, and that basically throws the French political scene back into a toss-up like we saw last year. And the reason why equity markets are seeing weakness here, Andy, isn't because the domestic French economy is that important for the domestic equity market. It's because there's always a chance that when you have this type of political hot potato going on, that the chances of a supernormal tax, a profit tax, some type of extra taxation on corporates is going to inevitably bubble up. So we've seen these fears percolate from time to time. But what we saw was the left-wing vote consolidate. Now the left-wing vote is fracturing. And I think Mark Carney in Europe this week is actually gets a front row seat into just what can happen when coalitions are a bit more fractured than they were before.
If he does get serious about government cuts, for example.
That's right.
Yeah, French stocks are up only about 4.6% this year, whereas Germany is up more than 20%, and even the Brits are up more than.
And if I may add, Andy, it's
13.
important.
Sorry.
No, of course, and it's important to understand. In France, the banks and financial services play a huge role in the market itself. So it's very credit sensitive relative to other economies like the United States. And this also tells you that what we've seen post the European elections, this type of dynamic, these fragile coalitions and these strategic voting initiatives, it's not the first place that happened. Don't forget, Germany has the AfD, and the center-left parties consolidated too. So there's a lot of those types of things going on across Europe. And it's likely we will see more of this in the future.
Yeah, I'm just looking year to date. Wow, Stellantis is down about 32%. It's a major stock in the French index. Renault is down about 30% as well.
Yeah.
Nvidia, what are your thoughts there? I mean, they have so much power, and we do know that tech companies are wary of that. They don't want to be just buying devices from one company.
They've been knowing that for a while. That's why every what's known as custom ASICs, which is basically the slightly modified versions of the Nvidia GPUs for accelerated computing. Elon Musk has that with his Dojo chips. Amazon has that with the Trainium chips. Avago sells that to Google with their TPUs, and they're also scaling that up with Meta. All of that being said, Nvidia is running the fastest. That's why when you're making a bet on your own silicon, you have to make sure you make a 5-10 year bet, because it's going to take you that long to keep up with NVIDIA's innovation. But that's not, debating NVIDIA's market position isn't the question this quarter, Andy. What we're talking about this quarter is actually around the magnitude of the beat that we need to see for NVIDIA, because the stock is priced for probably a $2 billion revenue beat this quarter. 46 billion is street estimates. Whisper numbers are around 48, if not a bit higher. So you need to meet that to basically justify where the stock is today.
If it doesn't get to that 48 billion in the quarter.
And what's key here isn't really the China chips, which I think gets a little bit too much play. It's about the medium-term expectations for data center revenues, which is where all of these chips by the hundreds of thousands and eventually millions are going into. So this is the division that's exploded in size within NVIDIA's customer base. But the question comes down to, is inference going to deliver the returns for the Microsofts, the Metas of the world, so that they keep buying more Nvidia chips as we go forward?
And why do we need all these new data centers? Is it just because AI is so greedy when it comes to computing power?
AI is driving the biggest physical investment in U.S. I hesitate to say in U.S. history, but I would venture to say it's probably close to that. And that's why you need tons of power. That's why there's so much demand for all kinds of natural gas turbines, the shells of the data center, on top of basically 70% of a data center is just Nvidia chips. So when you see data center growth, it's all because of AI-related demand. And that AI-related demand is delivering real revenues for these companies, which is why you're seeing them invest so aggressively. And we're seeing what's interesting about this isn't just NVIDIA's quarter, which I do think the bar is high for a very high-quality company. So I don't expect major moves, but I do expect a bit of a mixed report here. But keep the bigger picture in mind. This is a multi-year cycle where we are seeing capital-light companies like all the FANG companies, so Facebook, Amazon, Netflix, Google, turn into capital-intensive companies.
Yeah.
That's quite interesting.
Yeah, for years they were. They have a big staff, but they don't need to build the likes of factories, but now they are.
They're actually letting staff go to put $100 billion into the ground in data centers.
Oh, my goodness. Dan, thank you.
Thank you.
Very much. Dan Rohinton, Portfolio Manager at IA Global Asset Management.